Hey, welcome to the show today. Building wealth is about owning the right to own choices in the future. Choices for you and choices for what's important to you. Investing, or the practice of putting skin in a game where the odds are increasingly stacked in your favor over time, can often invoke emotions in us that we mistakenly thought we've already mastered. Emotions like fear of missing out, fear of being in over your head, you name it. When the rubber hits the road and your hard-earned dollars are invested, logically, you want to understand the environment in which your dollars are at play in. Now, this environment is in a constant state of change. Knowledge helps, but knowing the ledge, or the extent to which you can exercise sound judgment around your investment decisions, is potentially more art than science. So today, you may feel after watching this either scared of market conditions or inspired to take more ground. Of course, this isn't meant to be taken as guidance around what you should be doing, but I trust it will get you thinking. Now, my guest today is Julian McCormack from Platinum Asset Management. I trust that you're really going to enjoy this. Now, before we start, I'd really appreciate it if you could like and subscribe to help me grow this channel. I also want to mention our partner, Hatch. If building a US share portfolio is something that you're into, then check out the notes in the description for a special offer just for you to get started on a brand new Hatch account. That's it for me. Let's get started. Welcome to the NZ Everyday Investor, Julian McCormack. How are you?
Thank you, Darcy. I'm awesome and all the better for seeing you, especially in person.
Exactly. Yeah, the last time we caught up was via Zoom. And I think back then you were learning golfing, and now you're like a pro golfer as well, I hear, right?
That's an absolute lie. That's an absolute lie. Sometimes in my dreams I am, yep.
Yeah. Well, that's interesting dreams. I don't dream about golf in my dreams. I dream about like Whitney Houston chasing me down the road with a cheeseburger, right? So it's, hey, everyone has their dreams.
Everyone's got a hobby.
Yeah. Now, for the benefit of our audience, some of our audience will have remembered you and your voice probably in the last 12 months. We've caught up twice since then, and around about this time last year and a little bit more so, we caught up and we were talking about investing in a bubble and just were we in a bubble and what would it take to prick it, and then lo and behold, there was the mother of all pricks came along. So tell me, man, these metaphors are strange today. I shouldn't have had that extra coffee.
No, it's working well.
All right. So tell me, what do you do, Julian? I know Platinum,
Yep.
right? I'm full disclosure. I invest a little bit in Platinum, one of your funds. But tell us, what do you guys do?
The main part is avoid the real areas of heat. And look, one doesn't make oneself very popular by telling people that a lot of the stuff people are really excited about is very, very dangerous, and it's the excitement itself that's the point. And I would just ask people to remember that you know radio and auto stocks got crazy in the 1920s. Radio and autos were very important technologies. They completely sort of transformed the 20th century. And the internet was hugely important in 1999. And it's developed in ways that we couldn't have even imagined back then. We can, I can find my way around a city like Auckland on my phone. I mean, that's amazing. But the companies were all crap. And even the very fine businesses that actually led that market back then, Oracle, Dell, Cisco, EMC, Juniper Systems, Microsoft, they all fell like 60 to 80% and didn't make new highs for a decade. And they were all brilliant businesses. I mean, just fantastic businesses. So there is this huge excitement in markets. We've been saying for years that we're in a bubble, and we still are. But the really important additional factor now is there's emotion, and now there's like the human element of it. So there's very, very high retail participation globally, and very, very sort of idiosyncratic moves. So, the GameStop thing, or some of the sort of heat and emotion around stocks that was lacking previously, and now it's in full force and
In full effect, yeah.
in full effect.
And the rise of the DIY investor who's potentially more influenced by emotions than your research and logic and strategy.
And look, let me not give anyone the impression I think retail investors are any better or worse than institutional investors. I think many of them are much better. So that's fine. It's just that there is a distinct historical pattern around these things. And it's the other thing too is it's not that the entry of the retail investor signals the end of anything, you do want to sell into retail, but very slowly and not for quite a lag. The whole 1920s, or certainly the second half of the 1920s, I mean, that was retail participation. That was retail going crazy.
It's true, yeah.
The late 90s, I mean, there was very pronounced retail participation from 95, 96 on.
Yeah, right.
So,
So that lasted for quite a while.
It can go for years. It can
Yeah.
go for years. So
Because the impression is that they usually, well, my suspicion was that they caught on towards the last stage. They were the last ones to the party, and they had to clean up the mess in the end. But that's not true. They actually joined. They have in the past joined.
They do join somewhat
early.
late.
Yeah. Or some do. Yeah.
Exactly.
Yeah,
And you just don't get the shoeshine boys and widows and whatever, widows and orphans talking about stocks until very late in the piece. That's the sort of 1920s thing. But the modern equivalent would be, you jump in a cab and they ask what you do and you say you work in markets and they say, oh, well, they tell you all about their portfolio. That's an indicator of where you are in the cycle. Yeah. Because at the bottom, no one's talking about their portfolio.
No, that's right.
Well, and not even at the bottom. I mean, in the middle when everyone's when it's just boring.
Yeah, it's just normal life. Yeah. It just goes up and down a little bit, but it's pretty boring.
Yeah, totally. It's just boring. So now it's, you're in full sort of FOMO mode and there is risk around that.
Yeah.
Or put it another way, I mean, look, let's just be clear about it. We are at about the 100th percentile of market valuation in human history. So put it another way, you've got a negative real earnings yield on the US equity market, so that if you invert the PE, you get an earnings yield. So a PE of 25 is going to give you an earnings yield of 4. We're about 22, so it's about 4 and a bit. And inflation's comfortably higher than that. We printed 4.1 a little bit ago. We're higher than that now. Would
Correct.
be
Yeah, I get it. Yeah.
our assumption,
Yeah.
just from what we can see. And that means you've got a negative earnings yield on the S&P. That hasn't happened in 50 years without a huge correction.
Wow.
So
right.
I don't want to be gloomy.
Another way to reframe that, though, is that the real performance of the share market isn't keeping pace with
the
real
real
inflation.
expected return.
Right.
So not even the expected return, but the real earnings power
Yeah.
of stocks is not protecting you from inflation relative to the price that's being paid. Because if the price came down, the earnings yield would go up because the earnings won't change with the price.
Yeah.
So that's the key.
Yeah.
And equities are a real asset because companies have pricing power. So they are an inflation hedge.
Yeah. Yeah.
But not at the wrong price. I want to set all that out very clearly at the outset because I think where much of the commentary is directed towards very exciting stories, and that's fine. We love exciting stories, but our biggest holding was Microsoft like 10 years ago. Yeah. We owned basically the first sort of software as a service firm in history, which is PeopleSoft. I mean, great. We love great stories. Absolutely. We've owned Tencent for 7 years and blah, blah, blah.
Yeah.
But we just mustn't let ourselves get excited. And where I think a lot of commentary is all about disruption and technology and yada, yada. And that's all cool. But the price matters.
That's right.
It hasn't for a while, but
it
will.
Yeah.
It will.
Right.
Just based on history and none of this is predictive. This is not physics.
Yeah.
This is human physics.
Correct,
and humans are not, they're not as subject to predictability.
And we're not rational actors.
Not really.
And I remember the first time you spoke with me, you said something that I'm pretty sure it was you, or I'm going to credit it to you anyway.
Do it.
You said most of investing comes down to one simple strategy, which is shut up and just buy cheap stocks.
Yeah, that was
right.
me.
That was you, wasn't it? I thought that was profound.
Yeah.
Because it kind of does set some parameters around how you make investment decisions.
That's right. And it's a funny one though, right? Because we actually obsess about macro stuff, but that is because we are driven to investment decisions from the bottom up, but we're very aware of the context in which we're operating.
Yeah.
And so that's just a constant recursive process. That's just a constant, circular loop.
Sure. Yeah.
Of, are we okay here? And wow, this stuff's really cheap, or that's very expensive. Should it be? And it's
like self-awareness, isn't it?
Yeah.
You need to be aware of your environment, situationally aware.
That's right.
Because you're not a function of, but you're a participant in
We are. We are a function of. We all are.
Yeah.
You know, we're all a function of our biology, and that biology is wired to do dumb things.
Yeah.
In a quantitative sense.
Yeah, yeah.
That's the thing. So okay, I'll give you a quiz. I'm sorry, you didn't expect this.
No, it's fine. Hey,
It's questions without notice. So
I'll deal with it, man.
But I reckon you're smart, and I reckon you'll pass. In fact, I think you'll get a distinction. So I'll give you a
Well, you're puffing me up now.
Yeah, yeah.
The expectation's
No,
high.
I'll give you a little quiz. So what's 2 + 2?
4.
Color of the sky.
Blue.
Capital of Russia.
Moscow?
Yep. Last one took you a little bit, but you got
Yeah,
there
I'm
pretty
starting
quick.
to lag. Yeah.
But now, so just hold that feeling. And now what's the square root of 7 million? That's different. So what just happened there is different. And that's system 1 versus system 2 thought. This is a Daniel Kahneman thing, thinking fast and slow.
Right. So
And-
you're taking me from the linear to the exponential pretty quick in terms of these questions, right? So
Yeah. It's not good and bad. Like the simple answers are actually why we're a very successful species, because we can process information really quickly because we're super efficient.
Right.
So actually, in timed contexts, the best chess is played by a machine plus a grandmaster. They kill the machines in compressed time frames, because the computer always has to compute everything in a brute computational way from the first possible iteration to the last. It can't economize. They're beginning to. The neural nets are beginning to do that, but not very well. Even the AI ones.
Okay.
They're just way less. So and then Kasparov will come along and he'll tell the machine, "Now don't worry about all that crap on the side, and you got to worry about with her, the queen. You got to worry about where she's at, and they'll have intuition, and that efficiency. That's all system 1. That's all that 1 + 1. Bang. It's just bang. I just know. I got to look there. So why the hell do I raise all this?
Yeah. Why? Where are we going
Where
with
the
this?
hell are we going?
Yeah.
It's because that efficiency of thought, that system 1 thinking, is comfortable and easy, and it is efficient it's even efficient for our biology.
Right.
So it doesn't expend any energy in our body. When we have to engage, and like 7 million, you think, oh, hang on, okay, so 1,000 times 1,000 is a million, 3 times 3 is 9, so it's going to be a bit less than 3,000. But that's now chewing up the DRAM.
That's right. Your CPU. Yeah. Your CPU overload. Yeah.
Yeah. And so now my brain is consuming more of my blood sugar in my body. My pulse will have accelerated a tiny bit. My skin temperature will rise just a tiny bit, because that's a cost, right? Your body doesn't want that cost. Your body wants to keep you alive for your next meal, your next coupling,
Yeah.
and sort of hang the rest.
Yeah.
Because that's what you are. That's what we are. We are alimentary canals with a reproductive system, right? That is not investing. That is not quantitative thought. And so when people get soaked in an idea, it becomes comfortable. And when it becomes comfortable, it becomes easy, and it works both ways. So people will know they have to own Microsoft because they just know it. But it's not thinking. It's 1 + 1. And then when they're confronted with a new idea, say, hey, should you buy a Chinese property developer? They'll do the same thing, but in reverse. I go, no, that's crap. I want to vomit on you. Because no, it's all system 1. It's all 1 + 1. So that's a little tangent, but that's what we are always seeking to overcome in ourselves as investors, right? I'm not being critical of it. It's not that we're so good and they're not. I'm saying this is what we have to do. So you said before it's about self-awareness. That's the kind of thing we're always trying to be self-aware about what and why and how can we quantify that, and so really picking things apart.
Yeah.
And that's where we live as investors.
Yeah.
That's where we know we can make sustainable returns over time. And I can say that with some assurity because we've been doing it for 27 years.
Yeah.
And it's very difficult to express that to people in ways that don't piss them off.
Yeah, that's right.
Because what we're saying is, hey, all those software as a service stocks and enterprise software stocks and crypto-related investments and whatever, all that stuff's probably crap as an investment proposition, and you're probably there because of an emotional reaction to either the hype or the potential or whatever, and it could be very dangerous. That doesn't make you very popular at dinner parties, does it?
No, it doesn't. It doesn't. And it's an interesting way of way deeper than how I would have ever approached it. But even just last night, I was just Thinking about the concept of gambling versus investing,
Yep.
when you approach this, and there's a lot of emotion. It's chance. It's 50-50. It's random. Investing, you can be a bit more calculated, and you can actually, your reward is different. It's not just on or off. It's actually income and capital growth. So they're similar. There's some overlaps. Specifically, the chance. We don't know what the outcome is going to be, but that was my way, probably of very, very simplistically, to kind of cover the same thing, sort of. But what you're basically saying is that we are simple beings in a very complex system, and when we're making investment decisions, it's so easy just to act like a simple being because we get this feedback that, we're getting positive results. We're putting money into GameStop.
Totally.
I must be a genius.
Totally. And the other thing too is the time-weighted experience of that is by and large positive.
Okay.
Because markets as a mean reversion mechanism deviate from the mean slowly and revert to mean quickly.
Yeah.
That's what the cycle is. That's what it is. You'll start off at some lousy part of the cycle. It's 1982 or it's 2003 or it's like lousy, right? You're at the mean or below it.
Yeah.
So you can make money easily.
Yeah.
Volatility's high because people are uncertain. And you put money in then, and then up she goes.
Yeah.
Up goes the market. And then as it goes up, draws in more participants because, this is cool, that guy's making heaps of money and that lady just made a ton. So why aren't I doing that?
Yeah.
And so what is happening there is that you're deviating from the mean, but that's a slow process. So volatility falls slowly and rises quickly. And that is what the cycle is. So the time-weighted experience of that, particularly at this point or something like this point, we don't know exactly where we are in a cycle, people have made returns for ages. They will not believe it's possible for there to be a serious setback in a Microsoft or an Amazon or a Tesla because they've made money for ages and pots of it. But when that mean reverts, and we got a little taste of that in February, March 2020, it reverts very quickly and then it's just shock. Like, oh God. And then you get the sort of reaction you got post 0809, post 2000, post 89 in Japan, which is, sod that for a game of soldiers, I'm out.
Yeah.
And then you start the cycle again.
What was different then in March? Because the response was a little bit different from the powers that be in terms of injecting new cash into the system and resurrecting this Frankenstein monster. And, as long as the power cord isn't tripped,
exactly.
We're alive, right? So what was the difference? Is it the fact that the intervention kind of distorted something that should have happened naturally? Or was this separation between where we were at and where we needed to be back snapped into? Was that always, is that independent of manipulation, I guess is what I'm saying. Was that always going to happen?
It's a great question. There's always intervention and markets aren't natural, right? So I get very annoyed with sort of financy types who want to equate markets to some sort of natural force. It's crap. It's crap. If you look at natural ways of human interaction, they're not market-based at all. I don't have to pay my dad back for my school fees, right? But now let's go and look at every single society that anthropologists and sociologists have bumped up to through time. None of them are market-based.
True.
There are markets within them. There are market-like structures. There's exchange of value, right? But so there's nothing natural about this. It
or
drives
nothing
me mad.
free, right? So it's not
Nothing free and nothing unmediated by human institutions and intervention.
Correct.
It's constantly bounded by that.
Correct.
Right?
And you'd like to say that, hey, these constructs, these organizations are really actually just groups of people doing it. So isn't that a form of the market? But that's not the free market. That's some other. That's something else.
And that free market thing is totally impossible without very, very serious social structures around it, right? Like, because hang on, in a free market, like someone's a bit bigger than me. Why don't they just bonk me on the head with a stick and take my stuff?
Yeah.
Well, that isn't going to lead to a market society, but it's a very natural state of being. So that's a long way of preamble to your question.
Yeah.
Because there's always intervention. There's always something that happens. There's always, risk around the response to events in markets. And I think people think there's some sort of natural law about it or whatever. You better not believe that.
Yeah.
They can change. The powerful agents, be they governments or large enterprises or in China, it's the Chinese Communist Party, they can just change the rules whenever they want.
Yeah.
Right? Like one of the big risks that no one ever talks about with gold ownership, and I think it particularly applies to Bitcoin, is they can just suspend convertibility. Yeah. Like that's what FDR did.
Stop the on ramps and the off ramps.
Totally. That's what FDR did in 33.
Yeah.
He just said, well, he did, but this is the other thing. He priced up the price of gold because that gave banks back their solvency pretty quickly. He went from 22 to 35.
Yeah.
It's actually 2206 or 2260 or something, some weird number. And then it went to 35 an ounce.
Yeah. Yeah.
And that basically recapitalised the banks.
Yeah.
Because they had a whole stack of gold.
Yeah.
And he said, and guess what? You can't sell it except you can hand it in at the bank. Basically, the Federal Reserve said, hey, you know that legal charter under which we are created? That doesn't exist anymore. It's illegal for the Fed to buy anything except instruments backed by the full faith and credit of the US government. And they said, well, how about we just get a large fund management institution, maybe I shouldn't name, to establish a special purpose vehicle for us, and now we'll just buy corporate bonds.
Yeah.
They only bought LQD, which is the investment grade ETF of corporate bonds, but they said very clearly, and hey, we might go and buy, J&K, which is the junk one.
Yeah.
So all of a sudden, credit markets went, oh, okay, well that's fine, because that means there's an infinite amount of money that's coming in to make these good, right? So we're back to the races. So the credit market didn't seize. And that was the big vulnerability in the system. It's not perhaps beneath one to mention that Jay Powell's worth like 10 to 20 million bucks. That's all in equities. And he's a private equity guy. So he understands the value of like the junk market. It's very important for people to be able to get stuff away in the junk market.
Yeah.
So that's what happened.
Yeah.
And we got caught out by that because, we did a very good job on the way down. Yeah. And then at the bottom we thought, my God, nothing's broken yet.
Yeah, yeah.
You've only had like literally a couple of weeks of high spreads, and the corporate bond market is in very, very bad shape. There's hardly a AAA issuer in the world anymore. That used to be 15% of issuers or something. Now there's basically none. Yeah. And it's got this huge rump of both junk, but that's not the big bit. The really big bit is just investment grade. Yeah, triple B. The problem being is if the triple Bs go to a double B, most bond investors can't own them. Well, then they're stuffed. But not just that, then the market's stuffed. Because let me get the numbers right. I'm going to say I haven't actually looked over the numbers for a little bit, so I'm going to get the numbers wrong. But there's around about 3 trillion of triple B and about 1 trillion of all junk. Yeah. So if you get a really serious event and you get 500 bill drop from triple B to junk, it'll be half the market, and the market can't take it. Again, long way of saying, I think that was very clearly understood by the Fed, and the Fed reacted very quickly. And then there's another wrinkle in that, which is what happens in these events is it's actually the legal niceties, the legal loopholes and niches that prevent action quickly. Because no one has universal power in one of these market-based systems. Everything's conscribed by law. So when the Fed wanted to go and do stuff in 2008, it had to establish a whole lot of legal authorities to do it. Yeah. When Congress wanted to pass the TARP Act and then the Obama one, I can't remember the name of it, Putting America Back to Work or something act. Yeah. They had to wrangle about what the hell it was and blah, blah, blah. Had to wrangle about it, and it took for bloody ever. Yeah. It took like a year and a half from the proverbial beginning to dribble onto the fan to, okay, there's a couple of really big acts of Congress passed and we can actually
do stuff and fix some stuff. Yeah.
In that year and a half, you do enormous damage to the economy.
And that inaction is the issue, which you could almost look back at the Great Depression, and there was inaction as well. But this time it was super freaking quick.
This time it was like within weeks because the Fed went, yeah, cool, just sign here. Yeah, we did this.
We've got this ready.
We did this 10 years ago.
It was already baking.
Yeah, totally.
Yeah.
Here's one we prepared earlier.
Yeah.
And also, COVID's no one's fault.
That's right. True.
So it wasn't a moral hazard argument, because there's always a moral hazard argument that gets, well, not always, I shouldn't say that, but it is predominantly a moral hazard argument. It says, hey, you idiots, you bankers got us into this trouble. I'm not going to bail you out. Blah, 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 blah. That's all fine, but have that discussion in a couple of years. You don't have it when the system's seizing up, because it ain't the banker with the $17 million house is going to be in trouble.
Yeah, that's right.
It's a perverse but very natural
Yeah.
reaction.
And you
but
can
it's unhelpful at the time.
And you can understand why some would say then, at this juncture, you can understand why some would say, well, that was convenient.
Yeah.
Right. But what you're saying, it's maybe it is convenient, but it was possibly happening anyway. And it's a lot easier to fix a problem when it's just a wild weather situation rather than a couple of drunk bankers getting carried away. Right.
Exactly.
Yeah.
Exactly. So that is what the difference was. There was no interruption or problem with the payment system.
Yeah.
You didn't have a banking crisis.
Yeah.
It doesn't have to be a banking crisis. It can be a bond market crisis. It doesn't matter. But some form of cessation of the payment system, money creation system.
Yeah.
That's what gets you a Great Depression.
Okay.
So we didn't get it.
Yeah.
We didn't get it. It didn't happen.
Yeah.
That does, and now I think that is actually translating back into what's happening in markets in terms of valuation and behaviour, because sort of all of a sudden we know now there's no moral hazard.
Yeah.
So sort of all of a sudden we know now we can pay anything for stocks because we're always going to get bailed out. But that's not right. That's not right. The next one won't be COVID. So the next one you'll get some sort of problem, and it's probably not going to be anything like 08. No, it'll definitely not be anything like 08 because the banking system is absolutely rock solid. Like it is completely, like the equity base of it is crazily high and the reserving in it is massive. But people have forgotten that they needn't have a crisis to have a horrible bear market. So I grew up, my first entry into markets was just in the late 90s, and then I caught the 2000.com pop, and then I just lived through 3 years of bear market.
Yeah.
I mean, you didn't even have to check your computer. You just knew every day it would be down 0.5%.
Yeah.
You just knew. Because that's a bear market. There was no even discernible interruption to global growth. China was just hitting its straps. It was posting massive rates of nominal growth from a very low base, admittedly. The US had a very shallow recession, and that lasted for about 2 quarters. And you had 3 years of bear market. The market is not the economy. They influence each other in a reflexive way, using the George Soros term. That's about the best book on finance anyone can read as a start point is The Alchemy of Finance by Soros. So these things influence each other, but they're not the same. Anyway, long way of saying, markets are very expensive. We all got bailed out. We think we're all cool, but something will come along. And that something is very likely to be inflation.
Yeah. Excellent introduction. You're good at this, man. You're good at this.
You're welcome. Thank
So I
you.
was wondering where we're going to go and how to bring it back to inflation, because that's ultimately what I wanted to pick your brains on. But you can't really talk about it, I guess, unless you have that context. So thanks for that. So the way that I understand it, and just jump in at any stage and take it from there, but like the way I understand it is that part of the side effect, part of the side effects that may include nausea, vomiting, and diarrhea, and if it persists, go see your GP, is that the general price levels may increase over time, right? And that's what happens when you, number one, inject more currency into the system, and number two, give people a reason to spend it. And we've seen that. So take it from there.
Yeah, okay. Inflation is really complicated. So Milton Friedman's thing, inflation is always and everywhere a monetary phenomenon, is crap. It's not true. His monetarist economics thing lasted for about 5 years because everyone went, that doesn't work. So it's not that. It's a whole institutional framework that builds around the exchange value of things in an economy relative to themselves and each other and relative to the unit of exchange. It's hugely complicated. Can we
go back, though, like just to break down Milton Friedman, because this is the velocity of money and supply times. Do you want to just break that down a little bit more just for our audience?
Exactly. So Milton Friedman's thing was basically saying I can control inflation by controlling the amount of money in an economy, but it's just farcically oversimplified, right? And Friedmanite economists will beat me up for saying this, but in essence, because the velocity changes, and the velocity changes based on things that are just so complicated because it's all dominated by human behavior. So that then morphs into rational expectations, which is a sort of model that sort of persists, but was particularly the Volcker era of the Fed, where if we crush people's expectations of inflation, then inflation will fall. And that worked. The Volcker shock in 79, 80, whatever, that worked.
Yeah.
But in a particular way.
Yeah.
Like it worked by basically hollowing out American industry and crushing that economy. It was an effective dose of salts, but a pretty unpleasant one.
Yeah.
So let me try and come back to today. We persist in this world where, hey, here's the thing. I actually think what will have proven to be the case that we've just lived through is the sort of Reagan, the Thatcher era from 80 to 2020 probably ended in about 2020.
Yeah.
And now we're in some other thing,
Yeah.
but it ain't that. And that's important. So there's all these things on the margin that are changing and breaking. The gig economy is beginning to just sort of unravel on the margin. The London decision around Uber drivers, very important. Presidential support for the unionisation of the Bessemer Amazon fulfillment centre. That's a big thing.
Okay.
It didn't get up, by the way.
Okay.
It didn't unionise that thing. But that's official presidential support for the reunionisation of the gig economy in America. That's interesting, right? It's really beginning to grind at the margins.
Right.
And it's been coming for ages. But these things take a long time to gather momentum, and there's so much institutional power arrayed against them. But this fight for 15 thing, which is wanting to raise the minimum wage in the States to $15 an hour. I mean, can you believe it's not? But that's really gathering ahead of steam. But let me step back from all of that. That whole 1980 to 2020 thing, that's presented in a whole lot of ways. But I think the most important way is to specify what I think is the major driver of all the stuff we're talking about, which is inflation is redistributionary. It's redistributionary. Why do you think guys, usually, who have the gold, want hard currency? So they get paid back in the currency that they lent. It's a power thing. It's not at all this morality thing that gets put over it. So that redistribution was arrested and reversed all the way through 80 to 2020. And then you get to 2020 and you're not quite at the low. I think you're just off the low, but you're basically at the low of all time labour share of GDP versus capital's share of GDP.
Yeah, I think I'm following you. Yeah.
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 And that's massively deflationary.
Yeah, that's right.
Because if a rich guy earns $1, he ain't going to go and spend it. If a rich lady earns $1, she ain't going to go and spend it. But if a poor family earns $1, they spend it immediately.
Correct.
And it circulates.
Correct, yeah.
So that's getting to where we're getting to with inflation. But can you see how complicated that is? This sort of simplistic. And by the way, no central bank has a model of inflation. If you scratch them hard enough, they'll admit it. I'm not making that up. That's from a lass called Danielle DiMartino Booth. I think Richard Clarida admitted it.
Yeah.
There's the cracks are really showing.
Yeah.
They have general guiding principles, and they sort of think that there might be kind of an inverse relationship between inflation and interest rates.
Yeah.
But hang on a minute, we've just gone through 40 years of falling interest rates and falling inflation.
That doesn't make sense then, does it? Yeah.
If you're a scientist, 20 years into that process, you think, oh, geez, this model ain't very good because the model's crap. Yeah. It's crap.
Don't tell too many people that.
No,
because that's
everyone
pretty
needs
much
to know it, right? Like these are much more complicated things, because what actually really, grinds my gears is basically people go on TV and radio, generally politicians, and they're asked, hey, why can't we pay for that? And they say, well, because, and then economics. Yeah. The answer is just economics. Yeah. That answer's always crap. The why we can't pay for that thing for a sovereign government issuing bonds in its own currency is because I don't want to.
And we're talking about modern monetary theory.
Yeah, it touches on that. But it is literally just, I don't want to spend money on that.
Yeah.
Because when we go to war,
we can spend money pretty quick.
Hey, presto, off we go. Let's just go and we'll work it out later.
Correct.
But also the budgeting cycle doesn't work with an amount of money at the beginning.
Yeah.
They have a stab at what they might have. It's always wrong. And then they go and fill in the gap.
Yeah.
Well, so where'd the money come from?
That's right. And why am I paying taxes again?
Why am I paying taxes again? The tax thing's very interesting. We need the taxes because they imbue the currency with a value. why is it that we don't all pay each other in gold or Bitcoin or something? Because I can't pay my taxes in it.
Correct.
And some dude is going to show up with a gun eventually. Literally. Eventually, way down the line.
Well, yeah, who knows?
Tax fraud, you go to jail.
Yeah. Yeah.
So, and also it trims inflation, but it also curbs behaviours as well, in a particular sense, like tobacco taxes or sugar taxes or whatever.
But is it really the primary source that governments raise revenue to run?
It's the primary source. It's the primary source, but it's certainly not the only source.
Right, yeah.
Right. So it is the really difficult to quantify thing is that the unit of exchange that we all use in a country is reflective of like the trust we all have in each other. It's actually reflective of the value that we create as a society and how we share it with each other.
Currency of social cohesion.
Yeah.
Right?
And that's a difficult concept.
Yeah.
But why has Colombia's currency collapsed and Australia's currency done reasonably well? We're both very resource-rich places, or Argentina, very resource-rich places, relatively well-educated places at the beginning of the 19th century, relative to the rest of the world. And one currency does very well, and the others absolutely go to pot.
You have the answer for that one?
Well, it's all of the above.
Yeah.
It's like corruption,
That's true, yeah.
Abuse of power, impunity, the exclusion of a whole rump of society from the productive capacity, from being able to contribute to the productive capacity of society by dint of those things.
Yeah, yeah.
All of those and more.
Entropy, right?
Yeah.
Given enough time, everything falls apart anyway,
Yeah,
right? They just
yeah.
got there first.
Yeah, exactly,
Yeah.
exactly.
So
Albeit, entropy is interesting because human agency reverses entropy.
tell me more about that.
Well, so the whole point of entropy is things go from order to disorder.
Yeah.
But we can reorder things.
Yeah.
So this is very interesting. I don't know where I'm headed with that. But
Yeah.
the point about your mention of entropy is it sort of presupposes that there's a natural order to where things will end up in human interactions, and we can do whatever we want.
But when we do something better, is it really better?
Yeah.
That would be
that's-
my,
Yeah, that's fair.
Yeah,
That's
what
fair.
we're getting.
More orderly
Yeah.
might be
Yeah.
a thing. Anyway, I don't know where to go with that.
No,
because
neither do I.
It's too big for my feeble brain.
I doubt it.
But now let's get back to this question at hand.
Yeah.
Right now, quite clearly, markets are digesting whether or not we have inflation in the system.
Yeah.
Well, that's clear. We do, and whether or not it's transient or transitory or whatever.
Correct.
And I think, for all of the language and words that are being used around inflation, no one's positioned for it.
When you say no one's positioned for it, no one's positioned for significant sustained inflation.
No way.
Yeah.
I mean, the energy sector can't cop a bid, and that's the biggest driver of inflation. So wages and energy. And look, I get it. Like, energy is a dying industry. Don't tell me about it. I've got heaps of money in stuff that is betting against energy. But
Yeah.
hell almighty, you got to know that we need this stuff for another 50 years or something.
Yeah.
And it ain't going away. So I'm just saying that if you're really worried about inflation, you wouldn't be looking at stocks that aren't even pricing the current oil price, let alone pricing a higher oil price.
Right.
So that's one indicator.
Yeah.
The other is the financials. So the banking sectors, the banking sector globally is, again, slightly off its lows.
Yeah.
It's like below the lows of the GFC and below the lows of the Euro crisis in many cases, but off its lows of 2020.
Yeah.
And that is a sector that benefits from curve steepening, which would be the logical consequence of an inflationary environment.
Correct. Yeah. So the whole valuation of banks kind of needs that, right?
Yeah. And I use those two sectors because they ain't small.
Yeah.
They are massive.
Energy and finance.
Energy
right?
and financials are huge chunks of global market value and GDP. And it's quite clear from those indicators relative to equity markets that the market's saying, "No, I don't believe you, buddy. There ain't inflation in this system. Don't worry about it. It's going to go blip and back."
Yeah.
And I think that's a consequence of a sense that this inflationary and growth spurt is a reopening only event.
Right.
I think that whole discussion of inflation I might have conveyed to you, I don't think it is that in that fiscal and institutional sense.
Yeah.
It's not. It's not in the sense also of corporate behavior. So, we talk to Japanese and German and US industrials and all that, and they're all saying, "Hey, look, mate, it's just never been busier. We're just flat out." and our order book's 4 years ahead. Like, we can't keep up.
True. Yeah.
So that doesn't seem like a blip. It could be, because people double order and stuff in times of shortage. So you can get order books fall out. You know, things fall out of order books, whatever. But nothing's infallible. But and you know, this reinvigoration of capex, capital spending, is happening partially as a catch up for 2020 and COVID, but actually because of the trade war.
Yeah. Right.
You know, the trade war thing was really pernicious. It really caused investment to collapse because it introduced uncertainty into investment frameworks, and people just do less.
So, are we basically saying then that we're witnessing the symptoms of inflation? We can clearly see that, and so there's two parts to this, right? Like, how high will it go? How sustained will it be? Right? Like, what's the magnitude and the duration of inflation in light of the fact that we've had, like you said, we're at the end of some sort of era and we're in the middle of some sort of transition, perhaps, where it was incredibly deflationary, and the traditional framework for manipulating that didn't seem to ever really be working. No. Where does that leave us today then, in terms of, you know, how high it's going to get and how long it's going to last?
So let me break that apart in timeframes, because I think in the immediate term, it's entirely likely that everything sort of economic policy and fiscal policy wise is probably on balance disappointing, because the easy part is saying, I'm going to spend 1.9 trillion. Well, now get it through Congress. So there's always wrangling to go, right?
Yeah.
You know, so that's difficult. So, and also, actually, that's not a prediction. That's actually a description, because just look at the US 10-year. It got to 170 about 2 months ago, and it's bumped off at once, but it cannot get through 1.7% at the US 10-year for government bonds. Yeah. Now, that's interesting, because that same bond was yielding 3.2% 3 years ago in a much lower growth environment than today. I mean, hugely. Like, so it's actually just worth reflecting on the numbers. The nowcast for US GDP growth from the Atlanta Fed and the St. Louis Fed is 8% and 10% real, and there's 4 to 6% inflation in the system.
Okay.
We're talking about 12 to 16% nominal growth. And that is a quarter-on-quarter annualized rate. That's not this quarter versus COVID quarter. That's this quarter versus last quarter annualized. That's how you measure GDP.
Yeah, right.
Massive, massive numbers.
Yeah.
Now, part of that's a reopening thing, whatever. There's this thing called Apollo's Arrow. I haven't read the book. The thing it describes is in all of these post-pandemic,
post-war, post-apocalypse,
post-war, war, post-famine, post-war environments, humans behave in a particular way.
Right.
Old social structures drop away. Old social strictures drop away.
Okay.
People sort of get a bit of FOMO. There's a huge sort of reinvigoration of economies, blah, blah, blah. So, you know, maybe a simple example would be, Germany in the 20s post-World War One. I mean, economically they're pretty stuffed.
Yeah.
But hey, Berlin in the 20s was a roaring town.
Yeah.
So, roaring, bloody cabaret and cocaine and champagne and everything. It was just incredible sort of excess and hedonism.
It sounds like a fine family weekend.
Exactly. So, that there is something in this, and it's so there is this efflorescence of activity, and maybe that's transitory or transient. Fine,
because it is odd.
Yeah,
you can definitely say that.
Yeah,
simplistically,
totally.
it's strange.
Totally, and
it's a strange vibe.
Totally, and if you look at GDP, charted over time, you look at the GFC, it's a little blip, and then it goes up a little bit, but it's pretty. The recovery isn't as big as the blip. Yeah, the blip's deeper than the recovery is high, and then you muddle along. Yeah. This one, the blip is bloody deep because the economy shut. Yeah, but the bounce back is much higher. Yeah, and it's staying quite high. Yeah, its half-life seems to be quite long. So anyway, it's very interesting. I can see why people would want to believe, or can be inclined to believe, that this is transient or transitory. Now, I've used those words a few times. Yeah. That's because the Fed Reserve was using inflation, the descriptor of inflation, as transient. Transient means ephemeral. It means very quick to dissolve. Transitory means non-permanent.
Take me through that.
Well, in the long run, we're all dead.
Yeah, that's true.
Right?
There you go.
So everything's non-permanent.
Yeah, there you go.
Transitory is a different word.
Yeah.
And they changed that word.
Nice.
And there ain't a word that gets changed in a Federal Reserve release or a comma that gets put anywhere without it being very carefully scrutinised.
Because those are two words that may seem similar upon initial
I think
glance.
quite deliberately. And also the monetary regime globally has shifted from independent central banking designed to discipline spendthrift elected officials to one that's now designed to induce spending by government officials. Yeah. So they've shifted from either an inflation targeting or an inflation cap regime to basically some form of inflation tolerance regime.
That's right. Yeah.
And that's seems like a nuance. It's bloody important because it gives discretion. It's not the level that matters, it's the discretion that matters.
Right. We will tolerate higher levels of inflation.
And here's why.
Correct, yeah.
Right. So then you can sort of mount an argument that because for goodness sake, there is a 2% target rate of inflation in the States and they just printed a 4.1 and they're going to print a 6 or something. I don't know what it is, but if you look at the price series, they're up on where they were and they're at a 4. So it's going to be higher than that.
Yeah.
So you actually need to ignore it or to give yourself some wriggle room or whatever, or else you'd have to put up rates now. You'd have to under their own regime, under their own self-described, imposed regime. So yeah, it's different. It's different.
Yeah.
But then finally, we're not going to stay here. Economies cannot operate. The US economy cannot operate at a 10% real growth rate. It can't. It'll fall back. But what matters is the rate to which it falls back.
Yeah.
So the delta will be down, but does it go down to a 3? Well, that would be spectacular relative to expectation.
Yeah.
Does it go back to a -1? That would be really disappointing.
Yeah.
So, that's the question that markets are grappling with at the moment.
Yeah.
Our view as revealed preference in what we own is that growth picture is way better than what people assume. And when we and that's built from the bottom up because hey, that stock's cheap and we can see how it can grow a bit and model it out and hey, 3 years out we can make some pretty good money there. And so that's how we make decisions. But when we test that back against the macro, what we can see is the big sort of unpriced thing is that this obvious growth spurt is actually way longer than people think. And all our corporates are telling us that. So that's interesting, right?
Because at the start of this conversation, I was thinking, well, where can I hide from this, right? Now I'm thinking, well, you don't really want to hide, but that's the whole idea, right? Because we don't know. We genuinely cannot say what's going to be happening, right?
We don't.
That's what makes this hard, yeah.
And then just back to that mean reversion thing.
Yeah.
The mean reversion is bad. It feels awful. Yeah. And the correlations all go kind of to 1, so everything goes down. Yeah. But it matters what you own because you don't get paid back for a 0. That's just gone. But if you own something that you sort of know its balance sheet, it's got a track record and blah, 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 you're going to be okay over 10 years.
Yeah.
But I'm telling you, Darcy, there's a lot of zeros out there, mate. And I don't mean your fine New Zealand payment, accounting company.
Yeah.
I mean with a Z.
Yeah.
So these periods happen. And by the way, it doesn't have to be cataclysm. Let me not present myself as Chicken Little because the sky might not be falling. Remember what I said about 2000, right? It wasn't the end of the world. It wasn't a systemic crisis. It wasn't anything. It was just a bloody bear market. Markets got ahead of themselves, and then they ground down for years. No one bloody things didn't blow up.
So it wasn't like you were being pushed off a cliff or the market was being pushed off a cliff. It was more like almost Icarus, right? Or fatigue.
It just sort of deflated. It just sort of lost its mojo and collapsed under its own weight. And that's a much more common occurrence. That's a much more common occurrence in the history of markets than crisis.
Yeah, right.
But we've been mired in crisis for, getting on for 15 years.
Yeah.
So it seems like you can't have anything without a bloody crisis. People can go and get a very long run of equity markets over time, and it is an upward pointing slope.
Yeah.
Very reassuring.
Yeah.
But if you break apart the sort of 200 years that you're going to get in that and look by decade, there's lots of decades of 0. Yeah. And I mean 0.
Yeah.
Remember, Japan's where it was in 95.
That's right. Yeah.
Europe's no higher than it was in 2000. China's no higher than when it was in 2007.
Yeah.
Equity market level, nominal. So it's not even keeping up with inflation.
Yeah.
I mean, nothing. The US went from 1,000 points roughly on the Dow in 67 to 1,000 points roughly on the Dow in 82. 15 years of absolute zero capital gain.
Yeah.
That is entirely possible.
Yeah.
In fact, that's the more likely outcome than a crisis.
Yeah.
It's just that we all forget to think about it because
which
it doesn't
that's
capture our
and that's why it's
interest.
important to remember that it doesn't necessarily mean that you can't grow wealth during those times, but it just means that if you were owning the market, you might be owning a bunch of zeros, right? In terms of growth.
Precisely. So in that period, that 60s to 80s period, Peter Lynch, who was like the great doyen of investing when I was sort of a young guy, he compounded like 20% a year.
Yeah, yeah.
Like he killed it. When that, and permit me the chest beating, but in that period, 2000, 2004, we beat the market by 180% roughly in our international fund. But it wasn't just us, it was Buffett, it was GMO, Jeremy Grantham sitting in London, the Orbis guys who invest, sort of have a mindset a bit like us. Yeah. Maple Brown Abbott, domestically in Australia, Investors Mutual, domestically in Australia, all these value mob who've all been smashed for the last 10 years.
Yeah.
The main part is they avoid the heat, but the secondary part is they own things that respond pretty well to what happens afterwards.
Yeah. Price-wise,
by dint of being overly cheap on the way in.
Yeah. So this is probably a really good point in our conversation to, and eventually bring it into a landing, but also active and passive, right? Are we potentially going to see the rebirth of active funds management or a revival of sorts because we're entering into some sort of new regime where, maybe things can actually not be gamed, but maybe intellect can actually be used to achieve better than the average.
Yeah, let me preface the answer by saying markets can't be all passive. They break down because there has to be price discovery. Like big stocks, expensive stocks go down and cheap stocks go up, and really good companies get better, and so there has to be price discovery. So so there's a logical endpoint. No one knows where it is, but hey, I think we're a long way along that process. Point one. Point two, the emergence of passive, and when I say passive, I don't mean just ETFs, because you can use ETFs actively.
That's right, yeah.
Just the holding of market beta, so market performance in aggregate, trying to mimic that. Yeah. That as an investment sort of philosophy corresponds to 40 years of huge capital gain in the US equity market. When Johnny Bogle said, hey, this is a great idea, my recollection of the account of the emergence of his firm Vanguard is he had a bought deal with, an underwritten deal with US banks to go and raise, I think it was $200 million in 82, and he got 12. Because everyone said, piss off, mate, I'm not doing that. Markets haven't gone up for 15 years, you turkey.
Yeah.
Why? It was because it was exactly the point when they should have done that.
That's right, yeah.
Remember the mean reversion thing?
Yeah.
So
it was 82, yeah.
The mean there was that markets had just been grinding down in real terms. They'd gone flat, but in real terms, so inflation adjusted terms, they'd been grinding lower and lower and lower and lower and lower and lower and lower. So the mean had to revert back up. It doesn't have to go down.
The tide was coming in.
Tide was coming in.
Tide was out now. He recognized the tide was out.
But isn't that instructive that the reaction of professional investors at that time was, no way, not in your life. See you later. Yeah. Now go forward 40 years and it's like, oh, yeah, great idea, shipping in. Absolutely. All we need to do is economize on fees and get market beta. Yeah. Hey, mate, you might get a zero or negative for 10 years.
Yeah, that's right.
That is a very possible outcome. It's always a possible outcome.
Because it might be a king tide.
Yeah, totally.
Who knows?
Totally.
Yeah.
Totally.
But that's the thing, right? I think with regardless of what that model is of understanding what's happening in our environment, it works for a season. Sometimes it's only 5 years.
Yep.
Sometimes it's 40 years or 50.
Yep.
It works for a season. Maybe it works for a generation or an application, but it's not something that we can hang our hat on indefinitely with 100% certainty because the world changes. We're in a dynamic operating system, right?
No, exactly. Yeah. It's like the old thing about horse racing. There's no system. There's no system that works, right? Because people adapt to the system. And we're in a system when we're dealing with humans, we're in a system that does recursive loops on itself because it observes itself.
Yeah.
Atomic particles don't observe themselves, so they just do what they do, right?
Yeah.
But we all observe ourselves. So, hang on a minute. That endowment did really well out of just having passive exposure market, didn't have to pay any fees, and I'll just go and do that.
Yeah.
So the system changes itself, and in so changing itself, back to that mean reversion thing, it drives itself away from a mean, and then it reverts.
Got it. Yeah. It's fascinating. Yeah.
Yeah.
Man, do you ever sleep, or are you always thinking about this stuff?
I sleep like a baby.
Yeah. You're probably exhausted by all this thinking.
Exactly.
Awesome. Well, before we finish up, because we do unfortunately have to finish up, and I always enjoy these chats.
Me too.
What would you like to leave people with before we finish up?
Caution. It's time for caution, because no one feels that they need to be cautious. That's when you need to be most cautious. When brokers are jumping out of windows, go and buy some stocks. I'm not saying don't own stocks. I'm just saying know the risk.
So
there is, and let me just be really clear. There's no point in human history you've had markets this expensive without bad outcomes. It doesn't mean there's any predictive power about that, but I'm willing to bet you a ham sandwich on that.
I'm hungry.
Yeah.
In the meantime, then, if one was to take that advice on board, though, what's the alternative?
Well, the interesting thing, look, the first point is go and get advice. Like, get a coach. If there's any part of your life that you take seriously, get a coach.
That's right. That's right.
I've used the Rafael Nadal thing. I'll use it again. Rafael Nadal knows more about tennis than most people in the world combined. He's won 13 majors or whatever it is. But he has a coach. It's not the knowing that matters. It's not the being a clever dick that matters. It's the accountability. It's the scrutiny. It's the practice.
It's about the investor, not the investment.
Exactly. Like, what are you doing? Why are you doing it? Have you thought about this? That's what matters, right? So, point one. Point two is just, I cannot tell you what caution means relative to your lifestyle and requirements, but exercise it for God's sake. Know that years of negative return are possible. Years plural of negative return are possible. And it could be said likely. It could be said likely. Yeah. Now, I don't know that, but we shall see.
That's the thing, right? No matter how smart we think we are, that's not a proxy for knowing the future.
No, and I'd just remind people that the universe doesn't work like clockwork. It just doesn't, right? Whole swathes of things are just subject to probability. Yeah. And so we must be humble. Yeah. Maybe you can build a better mousetrap, but maybe you've got the best mousetrap you can, and you still ain't going to know. Yeah. So just be humble is big part of that. So that means, counter to my own advice, right? If I'm saying be cautious, well, just take that with a grain of salt and do what you want to do, right? Whatever. Yeah. My mindset is very, very cautious.
Yeah. Cautious, get advice, be humble.
Yep. And ready yourself for when you actually have to act. Yeah. So March 2020 was, in fact, it was really interesting because I didn't really capitalize on this myself. I was, on TV, in the press, whatever, saying to people about March 20, bottoming is a process. You are going to feel like vomiting to put money into this market because it can be down 8% tomorrow because it was down 8% last night. Yeah. One of the biggest moves in the history of markets. Yeah. But it's a process. So just eke it in over time, and then 10 years out, you'll be happy you did. Yeah. Because, 40% downturns in the local market, 30 odd in Aussies and Kiwis globally. That's a big move. Yeah. And big moves are always a good chance. Yeah. So don't try and pick the bottom. Yeah. Just know it's a process. Yeah. Just try and
awesome.
Loop it in. Yeah.
Yeah. Awesome.
All right.
Thanks very much, Julian. Really appreciate that.
My great pleasure always. Great to see you.
Good man. Cheers. Thank you very much.